Hi there, folks. Sean Broderick, Oxford Club, and I'm here in San Francisco, and I'm speaking to Tom Buchanan. Now, Tom is the CEO of Spyglass Energy, great little oil and gas producer. They're new, they're up in Canada, and they pay a heck of a dividend. And they have a lot of things going for them, and so Tom's going to just give us a brief overview of like what his company does and why we should probably look at them. Tom, could you please tell my subscribers a little about your company?
Sure. Thank you for having us. Spyglass is a junior oil and gas company. It was created in March of this year. Produces about just under 17,000 barrels a day of production. We're weighted 50% gas, 50% oil. The company is run by a management team that has a lot of history with most of the assets in the company from a prior life. Myself and majority of my senior team used to run a company that some of you may be familiar with called Provident Energy Trust. And we set out a couple of years ago and put Spyglass together, ultimately Spyglass together, which was the culmination of this three-way deal we did in March.
Okay, so you had like three companies. You really combined all those assets, and then through like cost savings, you've really lowered the costs over time. And these are long-term assets, right? I mean, you don't have to drill nearly as hard as like some other companies do in order to keep your production up. Isn't that right?
Well, our assets are what you call conventional oil and gas assets, but we have, we're really underpinned by one key asset, which is a what I'll call a world-class water flood asset up in an area we call Dixonville. It's a light oil asset, produces about 20% of our production, so about just over 3,000 barrels a day. But at the end of the day, that asset has a very, very low decline rate. And right now, over the last 2 years, it's been virtually flat with minimal capital required to sustain it.
And that is contrary to the story we often hear about these things. Though, frankly, I have to say, the whole industry has actually been producing so well. This new technology, they're learning new techniques, and they're just bringing them to bear. And so lowering their costs, extending the lifespan of these wells, and just keeping the production flow up. Now, what things do you guys hope to do over the course of the next year?
Well, a couple of things. The combination of the three companies, created I think, a good asset base. We have, one of the lower declines, as I mentioned, amongst our peer group, a 20% base decline, and which means that we have to replace 20% of our production each year with drilling. Most of our peers are 25 to 30%. So we have an inventory, a large inventory of light oil assets that we can drill to replace our declines with high netback light oil. And so that's the first thing, is focusing on drilling high netback light oil. Secondly, we've really focused hard on improving our cost structure. One of the things that we all talk about and understand entirely across our organization is that every dollar a barrel of G&A or operating costs that we save is about $6 million of cash flow. So we've dropped our operating costs by about $4 a barrel so far this year. And we've worked hard to reduce our G&A per barrel from close to $5 a barrel to now pushing the lower end around $3 a barrel. And so we're working hard at that. And operationally, when you look inside the organization, everybody's focused on cost control and executing on our ability to deliver our business plan through capital spending and delivering on our capital efficiencies.
Okay, great. Now, if I had to say there were some things that have been holding the share price back, you're in Canada, so we see the discount of like the Canadian oil to West Texas Intermediate. You also produce gas, and so there's that discount there. But those things are changing, and you're also changing the focus of what you produce to actually produce more oil. The other thing would be that you have a high debt ratio, but you're also working on that. You're going to sell like $50 million worth of assets next year and put $30 million of that toward reducing your debt, and then the next 20 into actually producing more oily assets. So if you can produce as much oil or even more oil than you get from like selling that other stuff off, that'll actually be a great step forward for your company, won't it?
Yeah, I think I'll address two of your questions there. The first one is, we've taken on, we have about $290 million of debt in our company against a $400 million line of credit. So we've got lots of flexibility within our line of credit. But however, when we compare to our peer group, we manage on our debt to cash flow is how much debt versus our annual cash flow. We're pushing about 3 times on an annualized basis, or a little over 3 times. And that's something we want to bring down closer to 2. It's sort of a benchmark within the industry that if you can run your debt to cash flow at 2 times or less, then you're viewed to be in strong financial shape. And so one of the ways we're getting there is selling off non-core assets. And we have executed on about $20 million of non-core sales this year. We've probably got another $5 or $6 million that we'll execute before the end of the year. And then next year, the plan would be that we try to sell off another $50 million of assets. And we've got some of those assets right now in the market under a process right now.
All right. Well, you have great friends at the banks because you have this great producing asset up there. So it's nice to have friends with money. And speaking of money, you have a yield on your dividends like 15%. Isn't that right?
That's right.
Now, brand new company. We can't speak about, one of the companies that's paid out a long time. They haven't done that yet. They are very new. However, they have a very nice yield, and they seem to have the assets in place to keep paying out that dividend, and they're doing the things that the market really is requiring them to stop trading them at such a discount to where they probably should be. So I think over the next year we could see some really great things coming out of this company. Is there anything you'd like to say to my subscribers before we wrap up?
Sure. Recognize that we are a commodity-based business, so we are susceptible, as you alluded to earlier, Sean, that we are susceptible to commodity price swings.
Right.
And, the differential or the discount that Canadian producers are receiving on oil versus where WTI is trading right now is fairly wide. And, we expect that'll come into more reasonable levels over the next year. But assuming that our forecasting is correct and that we can achieve the cost savings that we've already done and maintain those, which I expect we'll do, that we can execute on our business plan on selling non-core assets and then reinvesting money in terms of our capital programs on the capital efficiencies that we think we can do. Our business plan is very strong, and we expect that we'll be able to deliver and continue to deliver the dividend that we're paying now. So,
okay, great. Well, thanks very much for speaking to my subscribers.
Yeah.
Folks, thanks for tuning in, and I'll be back at you with more videos here from San Francisco.
Thank
Bye-bye.
you.